Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Tuesday, March 23rd, 2010. We start today's broadcast with a look at the euro-dollar pair, where we saw the dollar higher in overnight trading as the euro-dollar pair slid to 1.3475 prior to the open of New York trading. But then, as we had U.S. equities rally in the morning, the euro managed to pair most of its losses, sending the pair back up to above the 1.3550 level. Greece sovereign debt crisis continues to overshadow markets, and that had hobbled the euro in earlier trading, as it seemed that there will be no aid package agreed to in the EU summit that is coming up this week. So the market continues to watch what Germany and the German Chancellor Merkel will say in regards to a Eurozone bailout. One of the conditions that Germany is putting on Greece is that it must be unable to finance itself on the market before receiving aid, which creates an open invitation for the markets to turn off the financial spigots to Greece until a package is in place. The second concern is that German insistence that the IMF contributes substantially to any rescue. So these are some of the similar concerns we had starting this week, where we saw the euro dip but then rebound in New York trading, and we seem to be having a replay of yesterday somewhat, as we had a slide overnight that was paired in New York trading. So overall, what we have learned is that 1.3450 to 60 area, which has been important support in late February, held up again this week. And we'll see if we'll have a further retracement of this slide in the pair from 1.38 if we're able to move above this 1.3570 high we had established in yesterday's session. The euro versus the Swiss franc, meanwhile, slid below the 1.43 level, hitting a low of 1.4287, which is the lowest this pair has been ever. So there still doesn't seem to be any involvement of the Swiss National Bank in intervening in the markets in order to stop the slide, which has seen the pair move down from the 1.46 level down to the aforementioned low for today. Looking back at the euro-dollar pair, we see that this rally here came about as we had some increase in risk appetite on better U.S. equities. Turning to U.S. fundamental data, we saw that the sales of existing homes slid for a third month in a row in February, declining 0.6% on the month to an annualized pace of 5.02 million. While this was the lowest annualized level in 8 months, the drop was smaller than expected and could hold out some hope that the housing sector could see a turnaround in the spring. Existing home sales have stabilized around this 5 million level after sliding rather sharply the previous 2 months before that, after we had a surge in sales when we had the oncoming expiration of a $8,000 homebuyer tax credit. That tax credit has been extended, and with low mortgage rates and falling housing prices, we'll see if we see an increase in sales in the coming months. A second report put out by the Federal Housing Finance Agency showed that its housing price index for the month of January fell 0.6% on the month, following a 2% slide in December. Those two negative months that we can see here follow several months in which we have been oscillating around the 0% level, and we had seen some housing price increases. However, the past 2 months have put the annual rate now down at a 3.3% decline compared to January of 2009. Lower housing prices can help to stimulate some buying in the housing market. However, it also lowers overall household wealth, which could impact consumption. It also exacerbates the problem regarding underwater mortgages and foreclosures. What today's data shows us is that the housing sector continues to lag behind some other sectors in terms of the recovery. Turning to the UK, we saw consumer price data for the month of February, and the annual rate registered at 3.0% compared to the 3.5% we had seen in January. That reading was lower than expected and shows that inflation was cooler than projections. The core rate fell down to 2.9% compared to the 3.1% we had seen in January. Looking at the pound-dollar pair, we saw the pair slide in overnight trading, similar to what we had in the euro-dollar pair. And we hit a low around 1.4970. However, just like with the euro, we did pair most of our gains in the New York morning session. So we remain confined to the range we had seen in yesterday's session, and overall we continue consolidating in this pair as we had seen throughout most of March. We are posting some higher highs though, so that is a bit of a bullish sign for the pound. Another pair that continues to stick to its sideways range is the US dollar Japanese yen pair. We had the yen gain rather sharply in yesterday's session, but the pair found support at 89.90, which has been the level where we have seen buying pressure in this pair. We moved back to about the middle of our range from yesterday's session, so not much to report here except that we continue to stay in sideways trading. In a look at our commodity, one of our commodity currencies, the Australian dollar US dollar pair, we had set up this power line around 0.92, which is a very important level, as it switched its role from resistance to support and now is resistance again. Yesterday we came close to testing that level, and we tested again in New York trading following a short slide in overnight session on some risk aversion. However, the Aussie has made up its ground following our slide in Friday and in overnight Monday trading. So right now, higher US equities are propping up commodity currency pairs. The USD Canadian dollar, meanwhile, which had tested its resistance zone around 1.0230 in yesterday's session, tested that level again in today's trading, but was beaten back yet again. We slid back to 1.0150 area, which is where our 50-period moving average was, and right now we are finding support at that level. However, if we have a move towards risk appetite, we should see a sharp move back down to this 1.0050 level, as we've had a rejection of this support turn resistance level here between 1.0250 and 1.0230. In a look at gold, we see a very similar dynamic to our euro dollar pairs and our Aussie pair, as we had a slide in overnight trading where we tested our low around 1,095, but then as we had a higher New York stock, so we rallied, though we tested this resistance at 1,107. So we'll see if we're able to move above this level, and that would be a positive for our commodity currencies. Now let's take a look at some upcoming fundamental releases. Tonight at around 6 p.m. Eastern, New Zealand will post its current account, which will be followed by Japanese trade balance. Overnight, we get the flash manufacturing and services PMIs from both the Eurozone and Germany, but also Germany will post its IFO Business Climate Index, a pretty influential report, plus Eurozone releases its industrial new orders. Tomorrow at 8:30 Eastern, the UK will post its annual budget, and the US releases a measure of its durable goods orders. The US will follow that up at 10 a.m. with its US new home sales. At 1 p.m. we get the Bank of Canada Governor Carney speaking about monetary policy, which could have an influence on the Canadian dollar in tomorrow's session. And that will do it for today's recap. For more news, videos, and analysis, please visit our site FXTimes.com. I want to thank you for watching and wish you good trading.